All right. I'm here with Callum Laing, and he is a partner at Unity Group. How's it going, Callum?
It's going great. Yeah, looking forward to this conversation.
Yeah, I'm excited to get into some tactical pieces here around M&A. But before we get there, let's talk about your background. What got you into this space?
Sure. So, I was being an entrepreneur, so I was entrepreneurial kid, which is another way of saying a not very well behaved kid. But yeah, started kind of doing little hustles and things as a kid. My first grown up business was a recruitment company at the height of the .com boom, providing IP engineers into telcos in Europe, which was very successful. And of course, at the ripe old age of about 23, I assumed that success was completely down to my good looks and talent. And then the bubble burst, and I discovered I was not nearly as good looking or talented as I thought I was. So it was a bit of a rude awakening, but by then I was, I was unemployable. And so I stayed with the entrepreneurial side and actually moved over to Asia. So I was born in New Zealand, grew up in the UK, moved over to Asia about 25 years ago, and yeah, just been building businesses ever since then. The last 10 years, I've been working with my business partner at the Unity Group, really leveraging off the capital markets, and so we put together groups of small businesses under a publicly listed holdco, but we leave the founders in control of their businesses. So they get all of the upside of being a public company, but they get to run their own little small business without too much reporting into accountants and things. So that's kind of the day business, the day job. And then I have a bunch of sort of auxiliary businesses that I've created around that to help with investor relations, help people get their first board seats, understand how to be good board members. I have a capital raising community with hundreds of people around the world learning how to raise capital. So it's all kind of at that intersection of small business and finance.
Nice, very nice. So I think something fun to talk about next is preparedness. It's pretty much the most common question that comes up, how to prepare for an exit. Some people will say like, all right, day one, you got to be prepared. Some people will say the complete inverse of that, but I'm curious to get your take on somebody listening right now that's operating. How can they prepare?
So look, I think you kind of need to look at what's the definition of prepare. As an acquirer so we've taken 100 companies public over the last 10 years. I wish companies were more prepared. But having said that, it really doesn't matter. If the acquirer can see value, the fact that you haven't got your data rooms all put together and all of that sort of stuff is irrelevant. There was a really eye-opening story that actually happened way before I even got into M&A, but it was I met with a friend of a friend in London when I was still a young entrepreneur, and this guy was building data centers, not AI data centers like now, but this was like web hosting back in the early 2000s. And he'd built quite a successful company. And I said to him, what are the plans? And he said, this time next year I'll have been bought by Yahoo. And I was like, oh, really? Like, have they approached you? And he said, no, but I told my sales team last month that from now on, we just go after Yahoo customers and we do whatever we take. Even if we lose money, we'll take those clients. And I know that will piss Yahoo off, and then they'll come knocking on the door. And sure enough, like I don't think it took a year. I think it took about 3 months. And Yahoo came and said, "Look, what are you doing? We know you're losing money on these deals." But he was being such a pain that they were willing to buy him. And because they had approached him, he was in the power seat in negotiation. Whereas if he had gone and knocked on the door and said, "Hey, are you interested in acquiring me?" it would have been a very different process. So I thought that has always stuck with me as a very interesting approach. I understand your value, understand who would value you more than just the market. So when you put yourself up for sale through a broker or something like that, you're really competing with everybody else that's for sale. If you want to get the best prices, then trying to find those strategic buyers is definitely more valuable.
Yeah, well said. And that's a good transition into boosting value. So, what are some tactics that you've seen work when it comes to boosting valuation or boosting the value of a business that's getting ready to go through a process?
So it very much depends on industry. But look, a very simple thing. If most of what we deal with is small businesses, old economy, cash generating businesses. Now, most businesses are run financially for the lowest possible tax. And so your accountant will be doing everything they can to keep your profit at a minimum, which makes sense if you're paying tax on a profit. If you are seriously thinking about selling, you want to have a word with your accountant, and not all of them are very good at this because they're not used to it, but you start focusing everything around maximizing profit, which will also increase your tax. But if you're going to be selling for a multiple of profit, then that's a much better number to be going after. I think, look, buyers are looking for different things, and I think it's important to understand what your potential buyer is looking for. So a lot of people will focus on the potential upside. So if you're pitching to a potential acquirer, you kind of say, well, look, there's this opportunity and there's this opportunity. Every entrepreneur you ever speak to will tell you that last year wasn't as great as they hoped, but next year is going to be their best year ever. We're all delusional like that. We genuinely believe it as well. But the acquirer is going to be skeptical. So I think a lot of people get into this idea of just trying to sell this vision of a future. Depending on who you're selling to, that might be the wrong approach. That you might be, so if you look at family offices, for example, family offices are much less concerned about upside, they're much more concerned about downside. If they put money into your business, if they acquire your business, what are the chances that they're going to lose money on this deal? Whereas a venture capitalist doesn't really worry, like, if it's 1 in 10 or 9 out of 10 companies go bust, as long as one hits it out of the park. So they need to know that you have the potential to be $1 billion company. So understanding the acquirer's motivations is really critical to how you then prepare your business to be optimal for them.
Mm-hmm. Yeah, and I think it's a good segue into my favorite topic, which is mistakes. So you've taken 100 companies public. We talked a little bit about preparing. I think mistakes are kind of like these little gold nuggets that people listening can not have to necessarily go down that path fully to get the mistake notch on their belt. So what can you share around like common mistakes or some big ones that you've seen entrepreneurs make?
Sure. I think, look, it's a really critical point. We learn as entrepreneurs by making mistakes. Mm-hmm. That's, we're basically scientists. We test a hypothesis. If it works, we move forward. If it doesn't work, we move on to the next thing. And that's how we grow our businesses. Typically, selling the business, for most people, it's a once-in-a-lifetime opportunity. And the problem with that is that you tend to make all of your mistakes on the first one. So the first thing I would say is try and think of this not as a one-off opportunity, but just as a stepping stone. So I know you've done multiple exits. With every exit, you learn, you get better, you get more sophisticated, you understand more about what the buyer's looking for. Look, I like to think I've made every possible mistake going when it comes to the field of M&A. Often I make them twice just to really make sure that the lesson has sunk in. I think, there's an interesting perspective on it. Yeah, so if I look at our core business, so our core business is taking profitable cash generating businesses, putting them together in a group, leaving the founders in control, and taking that group public. Now, that's great for small businesses because when you're part of a public company, you can win much bigger contracts. It's much easier to find staff. It's much easier to do your own acquisitions. You've got the currency of a stock. So there's lots and lots of perks and advantages. The problem that small businesses have when they hit the capital markets is you have this values disconnect between entrepreneurs who are all about creating value and getting profit because they create value, and investors that are all about making profit and create value because they make profit. And those two things sound similar, but they're the exact opposite. So an entrepreneur, when they make a bunch of money, they reinvest that money into the company. They hire new staff. It's all about sort of jam tomorrow. Whereas an investor wants jam today. They can't understand why small business owners keep putting money back into the company. And so you have this disconnect. So I think when we first started taking companies public 10 years ago, we assumed everyone thought like us. We assumed when an investor said they're going to invest in the company that they were thinking more than a day or two, because we were thinking that. But you've got traders that are thinking in microseconds. Lots and lots of day traders will get in and out of a position within a day. And so we had to kind of completely adjust our thinking, and because you're not going to change the way investors think. So we had to do that. So I think it's quite important to understand the markets, just as you do with your clients. I think everyone has learnt eventually the harsh lesson that you don't sit in your bedroom and invent a business and build a business for a year and then go out and talk to a client. You start talking to a client as soon as possible to learn what they like, what they don't like, and you iterate and iterate. And it's the same with capital markets. It's the same with investors. The sooner you can learn from the market, you'll still make mistakes, but as long as you get that learning and keep iterating, you can improve much faster.
Mm-hmm. And when it comes to timing, we briefly touched on the dot-com boom and bust that was. And I think timing is one of those sort of always dynamic moving situations, and it depends so many different factors, people's lives, like the chapter they're in their lives, the business industry, the trends of each industry. But in your experience, when it comes to timing, let's say these small businesses that you're taking public as a group, when is it the right time for these companies to exit or go public?
So we're typically not looking for companies where the founder wants to exit. We're looking for companies where the founder is looking to take their business to the next level, and they're using the capital markets for that. But of course, they get liquidity when they become part of a public market because they can sell a little bit of their stock in a way that you can't when you have a private company. My business partner, Jeremy Harbour, has an interesting philosophy which annoyingly is probably right, which is basically you should sell your company as soon as you can. And his viewpoint is a little bit like we were talking earlier about the more often you can do this, the more you learn. But also, most entrepreneurs go into business for themselves because they want more time and they want more money, and they think they will get that by being an entrepreneur rather than an employee. As everyone knows that is an entrepreneur, you end up with less time and less money. And so if you can sell your business, then that gives you the two best resources back again. Suddenly you've got money again, suddenly you've got time again. And of course, as entrepreneurs, we're never short of ideas and we see opportunities everywhere. So if you can think of it rather than, hey, I'm going to get into this business and build it for the next 20 years, if you think of it more as a stepping stone, and look, you might decide some businesses that you do want to grow, but oftentimes things like Flipper, like a lot of them are relatively small businesses that you can just kind of rinse and repeat. So I think it's kind of critical to understand what your objectives are. It's quite risky to. Things change very, very, very quickly. We live in very, very dynamic times, and if you think, if we were having this conversation 3 years ago, software as a service was just smashing it, 20 times revenue, 30 times revenue. Everyone wanted to be software as a service, and that's been hit very, very hard by AI, and I suspect will continue to be hit by AI. So, the dot-com bubble, the real estate bubble, there's so many of these things. You just don't know what's going to happen, and so if you can get capital and time back, then that's quite advantageous.
Mm-hmm. And I want to talk a little bit about boards, because a lot of people listening are probably new to board seats. So from a high level, let's say a founder is listening to this, what can first-time board members and like founders stepping into that role, what do they need to understand, and like what are things that would be part of the exit that they would kind of need to focus on?
Yeah, so weirdly, I'm kind of I'm a very big fan of boards, which I say weirdly because most entrepreneurs think that a board is going to be restrictive, that they're going to stop you doing what you want to do, they're going to be expensive, all of these kind of things. But my probably the number one bit of advice I give to first-time entrepreneurs or young entrepreneurs is not only should you have a board, at the very least an advisory board, and it's very easy to set up an advisory board, but you should be sitting on at least 2 other advisory boards. Now, every entrepreneur will say, hang on, look, I'm working 24/7 on my own company. I haven't got time to think about somebody else's company. But what happens when you sit on the board of somebody else's company? A couple of things. First of all, we know that our own business is held together with masking tape and chicken wire, right? We know that. But everybody else's business looks perfect. It looks really polished. It looks like they're doing really, really well. So when you go and sit on the board of somebody else's company, you discover that actually their business is held together with masking tape and chicken wire as well. So like everybody's business is a little bit rubbish. And it's quite helpful to know that. Like that's quite good. But what you will see is that they've solved some problems that you haven't solved, and you've solved some problems that they haven't yet solved. And that's where you get value, because you learn things that you wouldn't have otherwise learned, and you give massive value because you can say, well, look, you should just be doing it like this. We started doing this 2 years ago, and it's completely transformed the way we do our marketing or our recruitment or whatever. So I'm a huge advocate for that. What's interesting about boards is there's 330 million for-profit companies in the world. Less than 1% of those companies have an active functioning board, and yet every single successful company you can think of has an active functioning board. So it kind of, causation correlation, but it makes you think, well, why don't smaller businesses get boards sooner? And mostly it's because we think it's going to cost us money. We think that those board members are going to restrict us from doing what we want. Actually, when you're a startup or an early stage business, what you're looking for is not a board of directors. You're looking for a board of advisors. It's people with more experience than you from different industries, different countries, different networks, more importantly. And those board members can be super, super valuable because just one introduction can completely transform the trajectory of your business. It could be an introduction to a partner, it could be an introduction to an investor or a new client, a new staff member, but it can be so valuable. And we started doing this when I was running public companies. We would bring in apprentice boards. When I had small companies, I would always do advisory boards. I learned very early that when I was trying to raise capital, it was much, much easier. I had no credibility as a young entrepreneur with my hand out saying, give me some money, I've got a great idea. When I put a board of advisors around me, suddenly I had massive credibility. There's one deal, one company that I was raising money for. I couldn't raise money at $1 million valuation. I put together a board of advisors of people that just happened to work for Google, Yahoo, Microsoft. They could have been the janitors for all the people knew. It was just the fact that I had somebody from Google, Yahoo, and Microsoft on my board of advisors. They weren't the janitors, but they could have been. And suddenly, my credibility went through the roof, and I was able, 6 weeks later, I was able to raise money at a $10 million valuation, whereas I couldn't raise money at a $1 million valuation. The whole thing had nothing had shifted about the business. Just the fact that I had those advisors sitting on my board. So it's incredibly valuable, and I've set up a whole business around training people how to do that and connecting companies with those boards now. Because I do think it's probably the easiest hack that anyone can do to give their company a boost that doesn't need to cost you any money. And yeah, it's super easy.
Nice. And I think that this is sort of an interesting segue with boards and getting people on your boards, raising money. A common question is around negotiations, like the best approach to negotiating, whether it's the value of what you said, going from 1 million to 10 million in valuation. What kind of tips can you share about like your experience with negotiating when it comes to increasing that value of the business?
Yeah, so I can give the advice, but you won't want to hear it. It's basically, they need to want you more than you need them. And so, like if I talk about capital raising, because a lot of entrepreneurs are kind of familiar with capital raising, and ultimately, oftentimes it doesn't even get to a negotiation. And the reason it doesn't get to a negotiation is because you go out begging for money. You don't really know what the investors want. You don't really know the difference between a hedge fund, a private equity, an angel investor, a real estate investor. You just see investor and you send them your deck. And that's not how investment works. You need to be building relationships, understanding what they're actually looking for, and then presenting yourself as the solution to a problem that they have. So what's the problem that they have? They need a return on investment. They need to know that their money is safe. They need to know what the upsides are. They may only invest in a certain type of niche. So you've got to understand what that is and try and position yourself to solve that problem for them. And ultimately, when you've got it's basic law of supply and demand, and it took us a long time to work this one out with the capital markets, but the value of any company is determined by supply and demand. Like if you've got multiple buyers that want to buy your company and there's only one company, the value of that company is just going to keep going up. If buyers aren't that interested and they've got lots and lots of companies to choose from, then the value of your business is just going to go lower and lower. And you see this playing out in the stock market. So over the last 50 years, companies that went public have gone backwards in value. 50% of companies have gone backwards in value. In the last 10 years, it's nearly 70% of companies that have gone backwards in value. And the reason is supply and demand imbalance. So 50 years ago, investors didn't have a lot to invest in. Like if a company went public, it was a really big deal. And you had that real estate or government bonds, basically, was your choice. Today, investors are inundated with deals. Every man, woman, and child is raising capital for something. You've got the biggest companies in the world still growing at 20-25% a year. There's so many opportunities out there. You've got REITs and you've got ETFs and everything is there. Another company going public isn't very exciting. Now, the other side of that, so your demand side is very weak. The other side of that is if you Google going public, everything is about how you exit. going public. So what happens is people think of going public as an exit. So your founder tries to take money off the table. The staff that have been underpaid for years but given stock options try and take money, like try and sell. The investment banks, the early investors, everyone tries to dump their stock on the market as soon as they can because they want to get liquid. And then the buy side isn't there because they've got so many other options, which is why price is going down. So ultimately, the best negotiation tactic is to constrain. So the way we do it with stock is we constrain stock. Everyone's locked up for 5 years. It's very, very difficult to buy our stock, but if anyone comes into the market, it spikes the price, and then we can keep the price going up. We can control the flow of stock up to a point. The same thing happens with a small business and a private company. You want to be getting on the radar of multiple potential acquirers, because the more people you've got looking at you, the more your value will go up. If you're just one of 1,000 companies that look the same, it's very, very difficult to get a decent price.
Well said. Well said. Got to have the demand. The demand has to be there. So that takes us to the finale. Knowing what you know now, what would you tell yourself 10 years ago?
So I get asked this a lot, and my glib answer is it really doesn't matter, because 10 years ago I thought I knew everything and I wouldn't have listened. Because I'm an entrepreneur and we tend to not be very good at listening. Look, I think I've made a lot of mistakes over the years, and you know, we've had a huge amount of successes as well, both in as an entrepreneur and as an investor. I think I would have given myself permission to make more mistakes faster. I think that's probably the biggest defining thing, is how quickly can you get to an answer and course correct. And I think I probably 10 years ago or 20 years ago was holding on to ideas much too long, even when the market was telling me they weren't great ideas. But like I said, I wouldn't have listened, so it really doesn't matter what I say.
Yeah, the making sort of high pressure decisions under uncertainty is like it's a skill on its own, to be able to just quickly figure out what doesn't work and course correct. I like that piece of advice. And maybe 10 years ago you probably knew it and you just you didn't want to hear it from future self. And I'm the same way. It's just kind of straight ahead, full speed. That's really the
I'll
way.
learn my own lessons.
Yeah, that's right. That's right.
I can run through this wall. This time it's different.
Well, cool. So where can people learn about what you're working on now?
Sure, LinkedIn's probably the best place. I spend far too much time on there. It's a good platform. So just search for Callum Laing. I don't think there's many that talk as often as I do. But I'm based in Singapore. I've got businesses in Dubai. Everything that we do is pretty global. So we've got listings in the US, we've got listings in Germany, UK, other places in Europe. Or callumlaing.com. If you go to callumlaing.com, you can actually get free copies of my book. So I've got several books on various different topics to do with business.
Very nice, very nice. Well, wherever you guys are listening on iTunes or Spotify, and the links to what Callum mentioned will be in the show notes. But thank you so much for coming on, sharing all your wisdom.
Yeah, pleasure. It's been fun.